Alright friends, so let's start with a new chapter that is called as Income from House Property, our official second head. So listen, there are a few things in house property that you should know. Rather than sticking on to the conventional theory, let's discuss house property in an innovative manner. Alright, so listen, the word house property, when you hear that word, what comes to our mind is only residential house property. Yes or no? So income from house property means if you have any rental income from property, that will be assessed under the income from house property. Rental income from residential as well as commercial properties will be accessible under this head. That is the first thing that you should know. Say for example, this is my rented building. Say I am the owner of this particular building and there is a tenant in my building. This is a commercial space and I am getting rent. My rental income is definitely assessed under the income from house property. Even though the heading says house property, it contains both the rental income from house property as well as commercial properties. So all the rental income related to property have to be assessed under this particular head. I hope you are listening. That is the first thing that you should know. Now, there is a concept called composite rent. Say for example, I'll give you an example. Say for example, I have a factory building, and in that factory, there are certain plant and machineries and other equipments, which I normally use for my production. So I have rented this entire premises. For rupees 1 lakh monthly rent. This entire premises on rent. Are you all listening? So what do I have? I have a factory building plus plant and machinery plus some equipments. I have rented this entire thing for rupees 1 lakh per month. This 1 lakh per month is called as what? Composite rent. Why it is called as composite rent? See, this particular rent is not only for the factory building, but plant and machinery is there, equipments are also there. So this composite rent is for the building as well as plant and machinery as well as for the equipment. So what to do with this composite rent? So what the Act says, if this composite rent is separable, you need to check whether it is separable or non-separable. What do you mean by separable? If from the rental agreement itself, you can separate the amount of rent for building as well as amount of rent for plant and machinery and equipment, it is called as what? Separable rent. Are you with me? Separable means if from the rental agreement itself, I can separate the amount of rent or quantum of rent for the building as well as for the plant and machinery and equipment. It is called as separable rent. So in the case of separable rent, then rent for building, that means for the factory here, will be accessible under the head house property. And rent for equipments, rent for plant and machinery or equipments have to be assessed under IFOS. If renting of plant and machinery and equipment is my business, then under PGBP. Are you with me? If renting is my business, entire rent will be under PGBP. Say I have many factories and equipments. I develop factories, install equipment, then I give it on rent. Say this is my business. Then the entire rental income will be assessed under PGBP. Are you all listening? Now, what if it is inseparable? What do you mean by inseparable? I don't know how much rent is for the building, how much rent is for the plant and machinery, how much rent for the equipment. I simply said I want 1 lakh per month. And the tenant said, okay. I cannot bifurcate it from the rental agreement. Then what to do? Entire rent have to be assessed under IFOS, not under house property, under IFOS. And again, there's one more point. If that entire renting is my business activity, then under PGBP. Are you all listening? If my entire rent is from business activity, then under PGBP, otherwise under IFOS. So this is the treatment of composite rent in income tax. Let me ask you one more thing. Say I have a land. I have rented out that particular land. What to do with that rental income of land? Which head it should be assessed? Under IFOS, not under house property. Say I have a barren land or a commercial land. I have rented out that particular land. All the rental income received by me in relation to that particular rental of land have to be assessed under either IFOS or PGBP. If renting of land is my business, then PGBP, and otherwise IFOS. Anyways, not under house property. For assessing an income under house property, there should be a building, whether commercial or residential. Otherwise, you cannot assess a rental income under the head house property. I hope it is clear. Moving on. So let's move on. Now, under the head salary, I have told you income is assessable based on what? Either due or received, whichever is earlier. Yes or no? Under the head salary, I have told you income is assessed on the basis of either due or received, whichever is earlier. What about house property? How the income is assessed? In house property department say you tax the annual value. What? You tax the annual value, which is determined according to section 23 of income tax. So that's the first thing that you should know. Determination of annual value. What is annual value? How to compute annual value? On this annual value, you are applying the rate of tax to compute the amount of tax. So let's understand computation of income from house property. So there is a format for computation of income from house property, and this is the format. So listen, what they are saying is you start with gross annual value. How to determine gross annual value is the next topic that I'll discuss. Then from the gross annual value, you can deduct what? Municipal taxes. What is municipal taxes? Corporation taxes, panchayat taxes, then municipality taxes. The property taxes that you pay is said to be municipal taxes. Then you will get net annual value. So listen, from the gross annual value, deduct the municipal taxes to get the net annual value. On net annual value, you can deduct two deductions which is mentioned under section 24. There are two deductions which is mentioned under section 24. You can deduct the both from net annual value. Which all are the deductions? Number one, standard deduction, which is 30% of your net annual value. Number two, interest on borrowed capital. And finally, you will get income from house property. These are the things that we have to study under the head house property. By finishing this, we can say chapter is over. So let's start with the gross annual value determination. So listen, for determining gross annual value, first you need to identify the type of house property you have. There are different classification of house property according to the house property head. Are you all listening? There are different types of house properties. So let's identify each house property and compute the income under the head house property. So the first type of house property which I say is let out house property. House property number one is let out house property. Tell me what is let out house property? A property which is actually rented out. You have rented out a particular property, that is said to be what? Let out house property. That is the first type of property we have. So let's determine gross annual value of let out property. How to determine gross annual value of let out property? Act say the first condition, you identify fair rent of the property. Fair rent of property and compare it with municipal value. Municipal value, and you pick the higher figure. This is the first step that they say. Listen, so what are they saying? You compute the fair rent first. What do you mean by fair rent? The rent, the market value of rent. Similar type of property in your locality, how much rent you can fetch? That is said to be what? Fair rent. We can say the fair market value of the rent. Fair market value of rent of similar property with the same facilities, same amenity, same location, etc. That is the normal rent that a person would get from similar kind of property said to be what? Fair rent. What is municipal value? Municipal taxes is computed on the municipal value. Or we can say the municipality or the corporation or the panchayat will have a minimum value on a property. On that value, they charge what? Property taxes. So we can say the valuation maintained by the statutory authority for charging municipal taxes is said to be what? Municipal value. You compare this both, then take the higher figure. That is the first step. Step number two, compare that higher figure with standard rent. Pick the lower value. So higher figure means what higher figure? This higher figure. You compare that higher figure with what? Standard rent. What is standard rent? In India, there is an act called Rent Control Act. Not to charge excessive rent from properties, there is an act called Rent Control Act in India, because no owner is supposed to charge exorbitant rent from a particular property. To control the amount of rent, department or Indian government has initiated Rent Control Act in India. So according to Rent Control Act in India, there is a minimum amount of rent, or we can say the maximum amount of rent that a person can charge from a particular property. That is said to be what? Standard rent. So standard rent, you compare standard rent and the higher figure and pick what? The lower figure. Are you all listening? So standard rent means rent which is given according to the Rent Control Act in India. So you pick the lower figure. And this lower figure is also known as what? Expected rent. This lower figure is known as what? Expected rent. What is expected rent? Department is expecting minimum this much rent from your property. Are you with me? This is the expectation of income tax department. Alright, income tax department is expecting this much of rent from your property. Now, you need to compare that expected rent with what? Actual rent. So, expected rent have to be compared with actual rent, then whichever is higher. The higher figure will be what? Gross annual value. You compare expected rent with the actual rent, higher figure can be called as what? The gross annual value. What is actual rent? What is actual rent? This is a let out property, right? So the rent which you have collected is said to be what? Actual rent. You compare it to the actual rent and pick the higher figure, and that will be the gross annual value. However, there is an exception for this point. What department say? If actual rent is less, if actual rent is less compared to expected rent, then you need to pick expected rent as the gross annual value. Yes or no? If actual rent is less compared to the expected rent, department's minimum expectation is expected rent. They will never agree that you are receiving a lower rent. That is your problem. We want you to show this expected rent as the minimum GAV. You are getting lower rent, that is your problem. You can increase your rent, because similar property, definitely we get more rent. We are expecting this much rent. But if the actual rent is less due to vacancy, if actual rent is less due to vacancy, then department say you can take GAV as actual rent. Then you can take actual rent itself as the GAV. You can take the actual rent itself as the gross annual value. So listen. If actual rent is less due to what? Due to vacancy, then only you are supposed to show GAV as the actual rent. Otherwise, higher have to be picked. Are you all listening? Now let me give you one scenario. This is very, very important. This is a tricky scenario. Listen. Say for example, my monthly rent, there is a let out property and my monthly rent is 1 lakh rupees. Expected rent is 15 lakhs. Alright, I have rented that particular property for 10 months. There is a 2 months vacancy. What is vacancy? The tenant left out and I'm expecting a new tenant, so that I'm reserving that house property and I'm waiting for a new tenant to come in. I'm not occupying that property. I have to keep it like that. If I occupied it, then it is altogether different story. Are you all with me? What do you mean by I occupied it? If I started living on that particular property, I cannot say it is vacant. Are you with me? That property, I'm expecting a new tenant. I keep it locked. I'm waiting for a new tenant. That is called as what? Vacancy. So there is a 2 months vacancy as well. So how much is the expected rent? 15 lakhs. How much will be the actual rent? 10 lakhs. Yes or no? Because it is rented out only for 10 months. 2 months there was a vacancy also. Expected rent is 15 lakh and actual rent is only 10 lakhs. You compare it with both. And here actual rent is less and there is vacancy. But you need to take expected rent itself as the gross annual value. Why? See, the point is, even if there is no vacancy, your actual rent is less. Here, say there is no vacancy, then also your actual rent is less. Yes or no? Actual rent is lower here, not due to vacancy. There is vacancy. We agreed that. But actual rent is less, not due to what? Vacancy. Your actual rent is always less. So what to do? Here expected rent itself have to be taken as what? Gross annual value. Department is very clear. If your actual rent is less due to vacancy only, you can take the actual rent itself as what? GAV. Otherwise, always go with expected rent. If your actual rent with or without vacancy is less compared to expected rent, you should take expected rent as the GAV. You got my point or not? Yes or no? This is actually very tricky. So department is very clear. Your actual rent is due to actual rent is less due to vacancy only. Then you can take. Say for example, if my actual rent is 1,50,000 per month. Sorry, say my actual rent is 1,50,000 per month. Then 10 months rent. Say only 9 months it is occupied. 3 months vacancy. There is a 3 months vacancy. Then 1,50,000 into 9. How much will be the total actual rent? 1,50,000 into 9, how much will be the total actual rent? 13,50,000. Here you can see, if the property was throughout let out there, throughout it was occupied, then 1,50,000 into 12 I would have received. Yes or no? If the property was throughout occupied, if there is no vacancy, I would have received an additional 3 more months rent. Then definitely my actual rent will be higher than the expected rent. Here we can say my actual rent is less due to vacancy. In the other case, my actual rent is anyways less. Whether it is vacancy or not, it is anyways less. In that case, I have to take expected rent. Here I can go with the actual rent itself as the GAV. Why? Because here the actual rent is less due to vacancy. Are you all with me? So let's move on with the next point. So we were talking about what? Let out property. So tell me friends, how do you compute gross annual value of let out property? You take fair rent, compare it with the municipal value, take the higher figure. That higher figure, compare it with the standard rent, take the lower figure. That lower figure is said to be expected rent. Expected rent you compare with the actual rent, take the higher figure. That higher figure is called as gross annual value. If your actual rent is less compared to the expected rent due to vacancy, then you can take actual rent itself as the gross annual value. Done. Just like a poem. Just like a poem, you can study this. Now, let's move on to the second type of property. Okay, friends. So, that is all about let out property. So, let's move on to the second type of property that is called as self-occupied house property. That is the easiest one. What do you mean by self-occupied house property? Self-occupied house property or unoccupied house property? Unoccupied house property also. So, friends, tell me what is self-occupied house property? What do you mean by self-occupied house property? I have a property and I'm staying over there. I have a property and I'm staying over there. For that property, how do you value GAV? Very simple. Department say gross annual value shall be nil. You can take gross annual value as what? 0. Are you all with me? And there is one more thing. I can show up to 2 self-occupied house properties. That means say I have 2 houses. And I haven't used it for let out purpose. And I'm staying in both the houses. Say 10-day first house, 20 days third house, second house, it is like that. So what I can do is, I can show both the properties as my self-occupied house property. According to the latest law, a person can show up to 2 house properties as what? Self-occupied house properties. And I can say that gross annual value from both the properties is 0. But there is a point. Say I have 2 house properties. I have 2 house properties. One house property let out. Another house property self-occupied. Let out means it is let out. I have 2 house properties. One is actually let out. If it is let out, then I have to treat it as category 1 and have to compute the GAV. I have 2 properties. Both are self-occupied. Then I can say that GAV of both are what? 0. Are you all listening? Now, 2 self-occupied house properties. Now there is one more thing called unoccupied house property. What is unoccupied house property? A property which is shut down, a property which is locked, and I'm not able to occupy due to my employment, profession, business, etc. in some other city. Say I have a property in Ahmedabad. Right now I'm in Chennai. So I'm not able to stay in the Ahmedabad property. That Ahmedabad property is said to be what? Unoccupied house property. Are you all listening? So unoccupied house property means I have a property where I'm not able to stay due to my employment, business, profession, etc. in some other place. And that property is said to be what? Unoccupied house property. net gross annual value for unoccupied house property also will be what? 0. And a few more things are there. You cannot claim municipal tax paid as a deduction from self-occupied or unoccupied house properties. Why? Department is not taxing any income from those properties. Hence, you are not supposed to claim municipal taxes paid as a deduction from your self-occupied or unoccupied house properties. But from let-out property, you can definitely claim what? Municipal taxes as a deduction. Are you all listening? So, I'll repeat that point again. From self-occupied house property, GAV is 0. On self-occupied house property also, you need to pay municipal taxes. On self-occupied house property also, municipality will charge what? Municipal taxes. You need to pay it, but you cannot deduct it as a deduction while computing income tax. Why? Because income is 0. We are not charging any income from that particular property. So, you are not supposed to claim any deduction from that particular property as well. So, 2 things we have studied. Which all other things? It is easy one. Self-occupied house property, up to 2 property you can show. NAV or GAV shall be always 0. You cannot claim any municipal tax paid as a deduction as well. Moving on to the third type of property. Third type of property. I will write it here. Third type of property. So, house property let out for part of a year. Part of the year and self-occupied for remaining part of that year. Remaining part of that year. Arey, what do you mean by this? Third type of property. A house property which is let out for part of the year and self-occupied for the remaining part of the year. What do you mean by this? I'll give you an example. Say for example, I have a house property. It was initially let out. On December 31st, my tenant said Tata bye-bye and he vacated the property. My tenant said Tata bye-bye and vacated the property. On which day? On 31st December of 2022. So on 1st January 2023, on the date of New Year, I thought of staying in this property. I myself occupied that particular property. Are you with me? It is not unoccupied. I myself occupied that particular property. Now, can you call it as self-occupied property with a vacancy? Can you call this property as a, let out property with vacancy? No, you cannot call it as a let out property with vacancy. It is a property where part of the year you have self-occupied and remaining part of the year let out. So, how to compute GAV in such cases? What you need to do is, you need to take fair rent, compare it with municipal value and pick the higher figure. And compare that higher with standard rent and pick the lower figure. And that lower figure is known as what? Expected rent. Expected rent. Then you compare it with the actual rent. You compare it with your actual rent. You compare it with your actual rent and pick the higher. And take the higher. And that higher will be your gross annual value. Don't say that there is a vacancy. There is no vacancy. Without vacancy, you need to compute all these things. That simply means what? If a property is self-occupied for a small portion of a year and let out for the remaining portion of the year, then you treat it as a proper let out property. And you compute the gross annual value. Don't say there is a vacancy. Are you all with me? But one point you can consider is, say instead of 1st January, I have entered that property on 1st February. Then I can say 1 month vacancy. Instead of 1st January in the example, say I occupied that property on 1st February. Then I can say 1 month vacancy is there. And I can consider that for my computation as well. Are you all with me? So which is the third type of property, friends? Repeat with me. Partly self-occupied and partly let out, or otherwise partly let out or partly self-occupied. You treat it as a normal let out property and compute the GAV, but never consider any vacancy. If it is unoccupied, if it is I'm waiting for some tenant, then you can take that period as vacancy, otherwise not. I hope it is also clear. Now, next property is said to be property number 4. deemed let out property. So let's understand what exactly is deemed let out property. Listen, say I have more than two property, more than two house properties, and I am occupying in all the properties. Occupying in all the properties. Say for example, I have house property 1, house property 2, house property 3. I haven't letted out any property. I am occupying in all these properties. Then what to do? As I've told you earlier, a person can show only two properties as self-occupied property. Are you with me? So any of, out of these three, any of two, I can show as what? Self-occupied. And the remaining will be treated as a deemed let out property. Deemed let out property. What is deemed let out property? We know that you haven't let it out. It is a self-occupied property only, but we will say that it is deemed let out. You can occupy up to two property. If you are occupying for more than two, two is self and the remaining everything will be deemed let out. Say I have 5 houses. Out of that 5, any 2, all the 5 are self-occupied. Out of that 5, any 2, I can show it as self-occupied. Remaining 3 will be deemed let out, even if it is self-occupied. Are you all with me? So which of the one should be self-occupied and which one should be deemed let out depends upon the value of the property. Depends upon the higher value property should be self-occupied. Lower value property only should be what? Deemed let out. So we were discussing the concept of deemed let out property. So tell me, what is deemed let out property? I have more than 2 houses. Out of the houses I have, any 2 self-occupied. Remaining shall be deemed let out. Now the question is, how do you compute gross annual value for the deemed let out property? That's what we are about to discuss. So let's understand how to compute gross annual value. Very simple. You take the expected rent as the GAV. That's it. You take the expected rent as the GAV. How do you find out expected rent? You take fair rent, compare it with municipal value and pick the higher figure. Then compare that higher figure with standard rent and pick the lower figure. This lower figure is known as what? Expected rent. This expected rent will be GAV if your property is deemed let out property. Are you all with me? So how do you compute the deemed let out properties GAV? Very simple. You compute the expected rent because you don't need to compare it with the actual rent. Why? Because there won't be any actual rent. Because it is a deemed let out property, not actual let out property. Done. So this is how you compute the GAV of a deemed let out property. From deemed let out properties GAV, you can definitely deduct what municipal taxes paid as a deduction, so that you will get the net annual value. So again, I am repeating, you have more than 2, any of 2 self-occupied, remaining deemed let out. So that's what the property number 4 is all about. Now let's move on to the 5th type of property that we have, that is called as house property held as stock in trade. That is a 5th type of property. So listen friends, house property held as what? Stock in trade. So you tell me, who will hold house property as stock in trade? Property dealers, real estate dealers. So if the real estate dealer having a house property and if they are keeping that house property as stock in trade, then what department says is, department say its net annual value, or we can say GAV, its gross annual value shall be nil. Its gross annual value shall be nil for a period up to 2 years from end of financial year in which completion certificate is obtained. So what do you mean by this? What do you mean by completion certificate, friends? What do you mean by completion certificate? Say before constructing a particular property or any building in India, the first process is to take an approval from the concerned local authority. You need to take building permit. It is called as building permit. You need to apply to your local authority. Whether it is panchayat, municipality or corporation, you need to apply for the building permit along with a plan. Then the municipality will approve according to the municipal law. So once it is approved, you can start your construction according to the approved plan only. So if there is any changes in the plan, you have to get prior approval of the local authority. Now, once you have completed your building, you need to submit for completion certificate. They will come and verify whether your construction is as per the plan approved. If it is yes, they will give you the completion certificate. Only after getting completion certificate, you will get building number. Only with the building number, you can apply for electricity connection, water connection, etc. So this is how the process is. So for every property constructed in India, you should obtain a completion certificate. Now, what department say here is, if you have a house property which you held as stock in trade, then from the year in which where you obtain completion certificate, you can count up to 2 years. For that 2 years, that property's GAV shall be nil. You don't need to compute any value from that particular property because you are holding it to sell it. But there is a problem. After 2 years, expected rent of that property shall be the gross annual value. So what they say, after 2 years, expected rent shall be the gross annual value. Now there is a point. Before 2 years, you can sell it off. You are holding this particular property as your stock. Whenever the buyer comes, you can sell it off. If you are not able to sell it within 2 years, then what will happen? Third year onwards, your expected rent shall be the gross annual value, and you should show that property's income as income from the house property, and you need to pay the taxes. That's what the department says. You have 2 years time. You know, nowadays the builder, when they announce the project itself, they will start selling it. All the flat construction group and all, they will launch a project. Even before starting the construction itself, they will be able to sell the project. So after completion certificate, you have 2 more years. From the end of the year in which you obtain completion certificate, you have 2 more years to sell. If you are not able to sell within the 2 years, then there's a small hardship for you. What is that hardship? Third year, its expected rent shall be the gross annual value, and you should start paying taxes. That's what the department say. I hope it is also clear. Moving on to the sixth type of property, that is house property, a portion let out and a portion self-occupied and a portion self-occupied. What do you mean by portion let out and a portion self-occupied? Say, for example, say this is a house property. Listen here. Say this is a house property. It has 2 floors. First floor let out. Then ground floor self-occupied. If it is like that, then what you need to do, you need to compute the gross annual value proportionately. What do you mean by proportionate? Based on the square feet of that particular property. First you need to do is, you need to take fair rent, compare it with the municipal value, take the higher, compare it with the standard rent, pick the lower. That is said to be what? Expected rent. Then expected rent have to be proportioned based on the square feet. Say for example, 500 square feet is the second floor, is the first floor, and 500 square feet is the ground floor. If it is like that, then you need to split this expected rent into 2, half. This half you compare it with the expected rent and pick the higher figure. Here GAV shall be what? Nil. If the same property, a portion let out and a portion self-occupied, then you compute it as if it is 2 properties. Then you compute everything proportionately. By separate computation you can do. That's what the department says. Is that clear? If a single property, a portion is let out and the remaining portion is self-occupied, you proportionately compute it. That's it. There is no point of any confusion. So this is what we do in this 6th type of property. So these are the different types of properties we have. So let's summarize all the properties we have learned. Listen. Property number 1, let out. GAV means expected rent, actual rent, higher figure. How do you compute expected rent? Compute the fair rent, compare it with the municipal value, pick the higher. Take that higher and compare it with the standard rent, pick the lower. Then that lower will be called as what? Expected rent. Compare the expected rent with the actual rent, and whichever is higher shall be selected as GAV. However, there is one exception. If your actual rent is less due to what? Vacancy, then you can take that lesser actual rent itself as the expected rent. That is the only exception we have. Then from the gross annual value, you can deduct municipal taxes paid. Now, second type of property is what? A property where it is self-occupied property. Second type of property which we have discussed is self-occupied property. GAV is nil. You cannot claim any municipal taxes itself as a deduction, and hence we can say NAV is nil. From GAV, if you deduct municipal taxes, you will get as net annual value. Municipal taxes, GAV, everything is zero for self-occupied property. Hence we can say NAV is zero. Then third type of property, which is the third type of property we have. It is said to be a property where a part of the year let out, remaining part of the year self-occupied. You treat it as a let out property and take the expected rent and actual rent and compare, and whichever is higher shall be taken as the GAV, and you can deduct the entire municipal value as a deduction. You don't need to compute it proportionately. Throughout the year, you can claim all the municipal taxes itself as a deduction. Now, and the next type of property is deemed let out property. You have more than two let out properties and more than two self-occupied properties. Out of two self-occupied, remaining deemed let out. For deemed let out, GAV shall be the expected rent. You can deduct all the municipal taxes, everything as a deduction. And next type of property is stock in trade. House property is held as stock in trade. Up to 2 years from the end of the year in which you have received completion certificate, NAV shall be zero. Thereafter, you should show the expected rent as the GAV, and you can deduct the municipal taxes as well. Then final is a house property where a portion let out and the remaining portion self-occupied. What to do with that? That compute proportionately. That's what they say. I hope this much is super clear for you. Now, let's move on and compute the remaining thing in this particular chapter. So that is treatment of unrealized rent. That's what we are about to discuss. Listen. Treatment of unrealized rent. So friends, tell me what you mean by unrealized rent. A rent where, a property where your tenant already occupied, already rent accrued, but you haven't received it. All right. You think that it is in a situation where you really doubt whether it is actually receivable or not. Are you all with me? A rent which is already accrued, but not in a position to receive is said to be what? Unrealized rent. So what department say is, you can deduct unrealized rent from actual rent. Unrealized rent means a rent which is not capable of being realized. That you can deduct it from the actual rent. Now friends, listen. Unrealized rent means you have to satisfy certain conditions. All the rent which is not capable of being received is not unrealized rent. Department say, if the following conditions are satisfied, then you can call a particular rent as what? Unrealized rent. There are certain conditions. There are certain conditions to be satisfied for calling a particular rent as what? Unrealized rent. Are you all listening? There are certain conditions which an assessee have to satisfy for calling a particular rent as what? Unrealized rent. Now let's understand which all are the conditions. So the conditions are very simple. Listen, there are 4 conditions. Condition number 1, the tenancy should be bona fide. What do you mean by bona fide? That means good faith. What does tenancy should be good faith means what? In good faith, you have given that property for rent. It is not to deceive income tax department. You acted in a good faith. You were expecting some rent from your tenant, but unfortunately, you are not able to get some rent. It should be in good faith. Now, the defaulting tenant has vacated or steps have been taken to compel him to vacate the property. If your tenant is not giving you rent, then what should you do? Common sense. If your tenant is not paying you the rent, what is the next step that you have to do? Throw him outside. Yes or no? That's what they say. The defaulting tenant either should have vacated the property or you should have taken steps to compel him to vacate the property. Now, step number 3. Defaulting tenant is not in occupation of any other property of the assessee. Say you have some other house property also. Your defaulting tenant should not be occupied any other house property. That means this is the only property where your tenant is occupied. The defaulted tenant should not occupy any other property of this particular assessee. If he has, then you cannot call that unrealized rent as what? Unrealized rent. That's what the department said. It has been tested. It has been tested, I think, in the November 2021 examination. It has been tested. So be very careful with the conditions. And finally, assessee has taken all the reasonable steps to institute legal proceedings for the recovery of unpaid rent or satisfies assessing officer that legal proceedings would be useless. What do you mean by that? Either you have to start a legal case against the assessee for collecting the rent, or you should convey to the assessing officer that legal proceeding is useless. What do you mean by legal proceedings is useless? Say, your tenant was a terrorist. All right. He already caught by the government. Our police department already took him over, and the court has, sentenced a death punishment, a death penalty to him. All right. So, the court has already sentenced death, hang until death. Now, you are about to give another case. Which is that case? I have some unrealized rent. You should take action against this particular person. Then what the court will say? Arey yaar, this is the maximum punishment that I can give. I cannot give any further punishment. Yes or no? So you should convey to the assessing officer that legal proceedings is useless. Alright. Or say, for example, your tenant is from Uganda. He vanished. You don't know where he is. So it is useless to file a case against that particular person, that it is sure that he will not come back to pay your rent. So these are the 4 conditions that you must satisfy for calling a particular rent as what? Unrealized rent. Now, so what is the highlight of unrealized rent, friends? Unrealized rent, you can deduct it from the actual rent for the purpose of computing income from the house property. Now let's move on. Let's understand what to do with the property taxes. So municipal taxes. As I've told you, municipal taxes is allowed as a deduction on actual payment basis. On actual payment basis. What do you mean by actual payment basis, friends? Say, for example, it is not due. Say, for example, this year's municipal tax is already due. I haven't paid it. If I haven't paid it, I cannot claim it as a deduction. If I have actually paid it, then I can claim it as a deduction. I'll give you one or two scenarios in relation to this. Listen. Say for year 2021-22, municipal tax 10,000 was due, but not paid. 10,000 was due, but not paid. In 22-23, 10,000 was due and I paid it. And 10,000 for 21-22 also I paid. Both the 10,000 installments have paid it in 22-23. Are you all with me? So in 21-22, no deduction for the municipal taxes because there is a default in payment. In 22-23, I can claim the entire 20,000 as municipal taxes paid and I can claim it as a deduction. So the point is, municipal tax is allowed as a deduction irrespective for the year in which you are making the payment. Irrespective for the year in which you are making the payment. Municipal tax is always allowed as a deduction in the year of payment, irrespective for which year you have actually made. If whether it is paid in this year, you can claim it as a deduction, otherwise not. So that's what they say. I hope it is clear. So that is the treatment with municipal taxes. Now let's move on. So next is the deductions from house property head. So let's summarize whatever we have learned. So what was the first thing that you have to compute? That is the gross annual value. From that you can deduct municipal taxes paid as a deduction. Then you will get what? Net annual value. From the net annual value, you can claim 2 deductions. Number 1, standard deduction. Number 1, standard deduction. Standard deduction is always 30% of NAV. Standard deduction is always 30% of net annual value. If your net annual value is 0, then standard deduction will also be 0. That simply means what? That simply means, say you have what? You have a self-occupied house property and the net annual value is 0, then the standard deduction also will be 0. You have a self-occupied house property, its net annual value is 0, standard deduction also will be 0. If you have some figure under NAV, then you can claim 30% of that figure as what? Standard deduction. That is under section 24, clause A. Now you have one more deduction which is under clause 24, clause B. So let's understand what exactly is 24 clause B. So 24 clause B say interest on loan. Interest on loan. What do you mean by interest on loan? Say for example, you have taken a loan for construction or purchase of the house property. You need to pay interest. If you have taken a loan for construction or purchase of a house property, you need to pay what? Interest. That interest is allowed as a deduction under section 24B. Are you all with me? So you can claim two deductions from the net annual value. Which are the two deductions? Number one, standard deduction, 30%, blind 30%. And there is one more thing. Apart from standard deduction and interest on loan, you cannot claim any other expenditure as a deduction. Say for example, yearly painting charges, yearly insurance charges, etc. is never allowed as a deduction. That's why you are giving standard deduction. Irrespective of your actual expenditure, you are not supposed to claim any other deduction. The only deduction that you can claim is standard deduction and interest on loan. Apart from that, you are not supposed to claim any other deduction. And there is one more highlight for standard deduction. Say you have no annual expense. You can claim standard deduction. Say your annual expense is 0. But still you can claim what? Standard deduction of 30%. So let's move on with the interest on loan. And let's discuss interest on loan in detail. So under that we can write interest on loan. Interest on loan has certain specialities. So let's understand what all are the specialities for interest on loan. So listen, you can split this interest on loan into two. That is interest for pre-construction period and interest for post-construction period. Interest for pre-construction period and interest for post-construction period. So let's understand what is this pre-construction period and post-construction period. Listen, let's understand what is pre and post. What is pre basically? Listen. Say for example, I'll give you an example for pre. Say for example, I have taken a loan on 1st April 2018. I've taken a loan for 1st April 2018 for construction of a property. For construction of a property. Alright, are you all listening? Now, the property's construction got completed on say 15th June 2022. The property's construction got completed on 15th June 2022. Completed construction on 15th June 2022. So what is the criteria to check whether the property's construction is completed or not? Date of receipt of completion certificate. That is the criteria to check whether a property's construction is completed or not. What is that? Date of receipt of completion certificate. So on 15th June 2022, I received what? Completion certificate. Now let me ask you one question. Which is the year of completion? Which is the year of completion? In which financial year the property's construction got completed? 22-23. Without any doubt, we can say 22-23, your property's construction got completed. Yes or no? So 22-23 financial year, construction is completed. Now you tell me, what will be pre-construction period? From 1st April 2018 till year of construction. Yes or no? So department say, and year of completion of construction is 22-23. So pre-construction will end with 31st March 2022. Because 22-23, it's already completed. Yes or no? So pre-construction period will always end with the 31st March of the preceding year to the year of completion. Are you all with me? So pre-construction period interest means the interest that you have suffered from 1st April 2018 to 31st March 2022. You have to pay interest until otherwise the loan is fully repaid. You need to pay the interest until you completely repay the principal amount. Yes or no? For 22-23 and afterwards, you can call it as post-construction period. Post-construction period. What is post-construction period? With the after construction. It includes the year of construction as well. Post-construction period includes the year of construction as well. Is that clear? So listen, our interest on loan can be splitted into two. Number one, interest for pre-construction period, and number two, interest for post-construction period. What is interest for pre-construction? What is pre-construction? It starts from the year in which you take the loan, ends with the 31st March of the preceding year to the year of completion. Year of completion is always post. Ends with 31st March to the preceding year, to the year of completion. That's what we have to say. Now listen, all the interest of pre-construction period, you cannot charge it from the house property head. The pre-construction period interest, you cannot charge it from the house property head. Why? Because there is no house property. House property will come into the picture only when it is completed. Yes or no? House property will come into the picture only when your property construction is completed. So department say all the interest that you suffer or you pay, that you are payable, whatever it is, have to be accumulated. All the pre-construction period interest you need to accumulate. And you can claim it as a deduction. You can claim it as a deduction from the year of completion onwards. How to claim it? It is claimed as 5 equal annual installment. It is claimed as 5 equal annual installments from the year of completion onwards. Say for example, in our let's come back to our example. So in the example which we have discussed, the pre-construction period started from 1st April 2018 and ends with 31st March 2022. Hope you remember. Are you all with me? For the entire interest during this period, you have to accumulate till the year of completion. Say it is 10 lakh rupees. The interest amount is 10 lakh rupees. Because only after completion of construction, there will be what? There will be house property. Once there is house property, there will be house property head. Before house property, you cannot open the house property head. So the entire pre-construction period interest you have to accumulate, and you need to claim it as a deduction from the year of completion. And how it is claimed? In 5 equal annual installment from the year of completion. Now this 10 lakh is the accumulated figure for the period of pre-construction period. Now you can claim it as a deduction. In which year? In financial year 2022-23. In 22-23, you can claim 1/5 of this 10 lakh. What is 1/5 of 10 lakh? 10 lakh divided by 5. That is 2 lakh. Along with that, you can claim current year interest as well. What is current year interest? See, for 22-23, if there is pending loan, you need to pay interest. Yes or no? Along with the current year interest, you can claim 1/5 of the pre-construction period's interest as well. Along with the current year interest, you can also pay 1/5 of the pre-construction period's interest as well. That's what the department says. Are you all listening? So it is only a simple point. So what they are saying is, if you have a pre-construction period interest, you accumulate it until otherwise your property is completely constructed. So from the year of construction onwards, you claim it as 5 equal annual installment deduction. Then in the year of construction and for the next 5 years, you have two components of interest. Number one, 1/5 of the pre plus current year interest. I hope it is crystal clear. Are you all with me? The one point you have to notice, year of completion is always post, not pre. Year of completion is always form part of the post-construction period, not pre-construction period. Yes. So these are the things that you need to know in interest. And there is one more thing. Moving on to the next thing under interest. Listen, friends. Let's discuss about self-occupied house property. Self-occupied house property. Listen. What was the gross annual value of self-occupied house property? According to what we have discussed, how do you compute the gross annual value of self-occupied house property? It is nil. Can you claim municipal taxes paid as a deduction in the case of self-occupied house property? No, it is also nil. Then, what will be the NAV, net annual value? That also will be nil. How much you can claim as standard deduction? That is also nil. Why? Because on 0 you apply 30%, you will get 0. Don't generate new mathematical formula, okay? On 0, if you apply 30%, it will be 0. Don't say, sir, it is 30. Okay. Now, the only deduction that you can claim is interest on loan. The only deduction that you can claim from a self-occupied house property is interest on loan. It's a super benefit. Interest on loan is allowed as a deduction. Interest on loan from self-occupied house property is allowed as a deduction. So let's understand how to claim that interest on loan. Listen. So what the department says is interest on is allowed as a deduction subjected to ceiling limit. Subjected to ceiling limits. What do you mean by subjected to ceiling limits? Here department say we are not charging your income. We are not charging your income, so we don't give you entire interest paid as a deduction also. Since we are not charging your income, we cannot give you the entire interest suffered by you as a deduction. There are certain limitations or certain ceiling limits for that. But for let out property, deemed let out property, etc., there is no ceiling limit. You can claim the entire interest as a deduction under 24B. Ceiling limit is only there for whom? Only there for self-occupied house property. Why? Because the department is not charging any income from self-occupied house property. The only point is you can claim a deduction, that to a benefit. So we are saying that we cannot give you the entire interest suffered by you as a deduction. There are certain ceiling limits. So that's what we are about to discuss. Let's understand what all are the ceiling limits. So interest on loan, under that we can write a flow chart. Ceiling limits. So the first point it say, if loan is taken on or after 1st April 99. Your loan is taken on or after 1st April 1999 plus it is for either it is for the purchase of new house property or construction of new house property. In the case of construction, there is one more condition. You have to complete construction within 5 years. You need to complete the construction within 5 years. In the case of purchase, there is no time limit because purchase does not require any time limit to complete. You can straight away purchase. In the case of construction, they say you need to complete your construction within how many years? Within 5 years. If in this case, you can claim up to 2 lakh rupees as deduction. As deduction for interest on loan in case of self-occupied house property. So this limit is for the self-occupied house property only. So listen friends, listen, it's pretty simple. If you have taken a loan and the loan date they have mandated, what is the loan date? It should be after 1st April 1999. Plus you have taken loan either for purchase or for construction of a house property. In the case of construction, you need to complete it within 5 years. In that case, how much is the ceiling limit? Maximum deduction for interest suffered on self-occupied house property is 2 lakh. And one more thing is there. Whether the interest is paid or not, you can claim this deduction. What do you mean by whether the interest is paid or not, you can claim as a deduction? Say the interest is payable. You haven't paid it, but it is payable. You can claim what? Deduction. There is no mandate that you have to actually pay the interest. Once it is accrued, you can claim it as a deduction. Are you all with me? Are you all with me? Moving on. Moving on. In other cases, what do you mean by in other cases? What do you mean by in other cases? Other cases we can say loan is taken before 1st April 99. Say you have taken loan before 1st April 99, maybe for purchase or construction. Or loan is for repair or renovation of house property. Or you have taken loan for repair or renovation. In that case, maximum deduction shall be up to 30,000 rupees. Maximum deduction shall be up to 30,000 rupees. Listen friends, If the loan is taken before 1st April 1999, irrespective of its utilization, maximum deduction 30,000. If the loan is taken after 1st April 1999, and if it is for the purchase or construction, up to 2 lakh. If it is for repair, renovation, expansion, etc., 30,000 is the limit. Are you all with me? This restriction is only for what? Self-occupied house property. Now, there are a few more things that you should consider. The first thing is, in the case of a loan, there are two components, pre-construction interest and post-construction, where it is a construction. So, department say both 1/5 of pre-construction plus current year interest should be less than or equal to 2 lakh. So, this 2 lakh is not only for the current year. Current year plus 1/5 of pre-construction shall be maximum 2 lakh, not more than 2 lakh. Have you got what I said? Are you all listening? See, the pre-construction interest you have to accumulate. Then you can claim it as a deduction from the year of completion. Thereafter, up to 5 equal annual installment, you can claim it as a deduction. So, in the year of completion, you can claim 1/5 of pre as well as current year interest. By adding both together, it should be less than or equal to 2 lakh. You cannot claim more than 2 lakh. This 2 lakh is not only for current year interest, it is for 1/5 of pre-construction as well. Same with 30 also. This 30,000 is both for 1/5 of pre-construction plus current year interest. 1/5 of pre-construction as well as current year interest. How it is 2 and 3? 2 lakh loan is taken after 1st April 1999 for purchase or construction. Then adding 1/5 as well as current year, it should be less than or equal to 2 lakh. If the loan is taken for repair, renovation, or if it is taken before 1st April 1999, 30,000 is the limit. That 30,000 is adding both current year as well as the 1/5 of pre. Are you all listening? And this restriction is only there for what property? Self-occupied house property. For let-out property, there is nothing. You can claim all the interest as a deduction. Only for self-occupied property, these kinds of limitations are there. Now listen. How many self-occupied properties a person can have? How many self-occupied properties a person can have? Maximum 2 properties. Yes or no? This ceiling limit is not property-wise. It is total. It is total for the self-occupied property. It is not property-wise. What do you mean by not property-wise? Say for example, I have house property 1. We will discuss different permutation and combination. I have house property 1. And loan is taken after 1st April 99 plus for construction. What is the maximum amount of interest that I can claim? House property 1 is self-occupied. What is the maximum amount of interest that I can claim as a deduction? How much is it? 2 lakh. And I have one more house property. One more house property. For that also I have taken a loan which is after 1st April 1999. Plus it is for construction. For that also I can claim 2 lakh. Yes or no? By adding both together, the maximum deduction I can claim is only 2. It is not per property I can claim 2. Maximum deduction is 2 lakh. Are you all with me? Now listen, there is one more possibility. Say I have house property 1, loan is taken after 1st April 99 plus for purchase. Alright, and the interest is 2 lakh. Maximum limit of interest for that particular property is 2 lakh. I have house property 2, loan for repair. I have taken a loan for repair. Then the maximum deduction for that property is 30,000. Yes or no? Adding both together, maximum interest is 2 lakh. I cannot claim 2 lakh, 30,000. The maximum is the higher 2 lakh limit. Are you with me? Possibility 3. I have house property 1, which is taken a loan for repair. I have house property 2, I have taken a loan again for repair. House property 1, maximum deduction 30. House property 2, maximum deduction 30. Both together, maximum deduction 30. Both together, see, both will get only 30. Yes or no? Both together, maximum deduction shall be 30, not 2 lakh. depends upon the type of house property I have and depends upon the ceiling limit. Overall ceiling limit can be either 2 lakh or 30,000. That's what the department says. If you have more than one house, self-occupied house property, overall limit can be either 2 lakh or 30,000 as the case may be. Is that clear, friends? Alright, so this is how you compute the ceiling limit for what? Your self-occupied house properties. Now, I'm repeating it again. Self-occupied house property as well as let-out house property, you can claim interest as a deduction, whether it is actually paid or not. On payable status also, you can claim it as a deduction. Now, one more thing, let me ask you. Listen, say I have a house property which is situated overseas. I have a house property situated overseas. I'm a resident and ordinary resident. As we have studied, for a resident and ordinary resident, your global income will be taxable in India. Are you all with me? Say I have a overseas house property. Say I have a house property in France. House property in France. And I'm getting rent from this particular property. I'm a resident and ordinary resident. My first question is whether this rent is taxable in India or not. It is definitely taxable in India on account of residence rule. Yes or no? So I have to compute the GAV as usual. I have to take the fair rent of France, municipal value if any of France. If it is not available, then don't compare. Then standard rent if available in France. If it is not available, don't compare. Expected rent, then actual rent, compare it and compute. From the GAV, I can claim municipal taxes paid in France as a deduction. Municipal taxes doesn't mean always Indian municipal taxes. If French property's income is taxable in India, then French municipal tax paid is also allowed as a deduction. If that particular property's income, if the department can tax that income, then department should give us deduction for the municipal taxes I have paid in France. You got my point or not? So that's what they say. Now, moving on with the next concept in house property. There are a few more concepts remaining in house property. So, next is inadmissible deduction. Let's understand what exactly is inadmissible deduction. So, that is under section 25. Section 25, inadmissible deduction. Inadmissible deduction. So let's understand what exactly is this inadmissible deduction. Listen. Say for example, see if you have interest on loan taken for a house property, say you have interest on loan which you have taken for a construction or purchase of house property. Construction or purchase of house property. Then this interest is allowed as a deduction under section 24B. Yes or no? Then this interest is allowed as a deduction under section 24B. If it is self-occupied, subjected to ceiling limit. If it is deemed a let out or actual let out, then no ceiling limit. But department say, if there is a default in deducting TDS, if you haven't deducted TDS from this interest, then such amount is not allowable as deduction. So what department say is, so interest chargeable under this particular head, if it is payable outside India, one point I forgot to tell you, interest on loan which is payable outside India. What do you mean by payable outside India? One point I forgot to write, payable outside India. What is payable outside India? So I'll give you an example for a better clarity. Listen, I'll give you a detailed example. So this much in depth they haven't asked in exam, but this is the next possibility. All right. So listen, I'll create a scenario here. So you need to tell me whether it is taxable in India or not. So friends, listen. Say I want to construct a house property in India. For that I took a foreign loan. There is a non-resident who have given me the loan. I am JK, resident in India. If I've taken a foreign loan, then I need to pay interest to this non-resident. Yes or no? If I've taken a foreign loan, I need to pay interest to this particular non-resident. Hope you remember under section 9. If interest is payable by a person resident in India, then that interest shall be deemed to be accrued or arised in India. Hope you remember. If interest is payable by a person resident in India, then that interest shall be deemed to be accrued or arised in India in the hands of non-resident recipient. Deeming fiction, section 9. So this interest payable by JK shall be deemed income in the hands of this NR. This interest payable by Mr. JK shall be deemed income in the hands of NR. So listen. So this interest income is definitely taxable in India in the hands of non-resident according to section 9. So the point is, when I'm making this interest payment, I'm supposed to deduct TDS. TDS. What do you mean by TDS? Tax deducted at source. There is a separate chapter called TDS, that is called as tax deducted at source. Say I have defaulted in deducting TDS. I means the resident's responsibility is to deduct TDS from that particular interest. If I have made a default in deducting the TDS, then what department says, this resident is not permitted to claim that interest as a deduction under 24B. It is my responsibility when I'm making the payment, I have to deduct the TDS. If I have made a default in deducting TDS, then I cannot claim that interest as a deduction under 24B. If I've defaulted TDS, don't claim that deduction. That's what the department says. It is inadmissible deduction under section 25. I hope it is clear. Now, there are a few more concepts in house property. By that, we can say house property is over. 2 more concepts remaining in house property. By finishing that, we will solve some problems also. All right. The next thing that we have to discuss here is treatment of section 25A. It is section 25A. Treatment of arrears of rent and unrealized rent received subsequently. Treatment of arrears of rent and unrealized rent received subsequently. So let's understand what exactly is this phrase. What do you mean by arrears of rent? Hope you remember. What is arrears of rent? So let's understand what is arrears of rent. I'll give you one example to understand what is arrears of rent. Listen, say for example, there is a building owner. I'll call him as BO. BO means what? Building owner. And JK is the tenant. Ten means tenant. Okay. So building owner and tenant, they had a rental agreement in 2021-22. 21-22. And according to the rental agreement, 10 lakh was the annual rent. 10 lakh was the annual rent. But building owner told the tenant that I need 2 lakh additional. I need what? 2 lakh as additional rent. And the tenant said not possible. You agreed on 10 lakh. Now you cannot ask me more than agreed amount. I will not give you that additional 2 lakh. Then building owner said it is not like that. Every other property is getting 12 lakhs. Mine was only 10. So it was a mistake from my side. So you should give me what? 2 lakh. So they had a dispute in between. And they filed a case in the court. Are you all listening? And the court in 2022-23 ordered that tenant is supposed to give BO 2 lakh rupees additional. Tenant is supposed to give 2 lakh rupees additional to building owner. So the court ordered like that. Are you all with me? This 2 lakh is accrued only in 22-23, only after the court order. But this is for the year 21-22. Yes or no? 21-22, the rent was 10. Tenant said that I will not pay you an additional 2 lakh. But building owner insisted the tenant to give the additional 2 lakh. They got clarity only when the court has given a direction on that particular matter. And the court direction came in 22-23. So this 2 lakh is said to be what? Arrears of rent received subsequently. Because you cannot add this 2 lakh with the actual rent of 21-22. Why? Because actual rent received only is 10. The 2, whether it is accrued? No. Because it is not, the position was not clear. Because whether the tenant is required to pay that additional 2 or not is clear on when the court has given a order in relation to that particular matter. Yes or no? So what department says is this 2 lakh is an arrears of rent and which is received in the year 22-23. Then what to do with this? Department say this 2 lakh have to be treated as an income under the head house property. That's it. If you have received arrears of rent subsequently, then you need to treat that amount of arrear received as your income from the head house property, and you can claim standard deduction from that. 30% of 2 lakh will be the standard deduction. How much is 30% on 2 lakh, friends? 30% of 2 lakh will be 60,000. You can claim 60,000 as a standard deduction, and the remaining 1,40,000 you need to pay. You need to show it as income, and you need to compute taxes on that 1,40,000. Are you all with me? So if you are in receipt of any arrears of rent, then that arrears of rent have to be taxed under the head house property in the year in which it is actually received. It is not for the year it is received. It is the year in which it is received, which is the actual year of receipt here, 22-23, and it is received for 21-22. Yes or no? So that's what they say. Now listen, what about unrealized rent? That you know, a rent which is not capable of being realized is said to be unrealized rent. Say there is an unrealized rent in 2021. You have completed or satisfied all the 4 steps, and later on, say in 22-23 or later on, that person came to you and paid the unrealized rent. Are you all with me? Then what to do with that? When you receive that unrealized rent, you treat it as your income under the head house property. You can claim standard deduction from that particular unrealized as well as arrears rent. Are you all with me? So the point is very simple. Both arrears of rent and unrealized rent have to be assessed under the head house property, irrespective of the fact that whether you own that house property in the year of receipt of arrears of rent or unrealized rent. What do you mean by that? Whether you own that house property, say for example, in the above example, on 31st March 2022, building owner sold the house property. In 22-23, when court ordered to pay additional 2 lakh, this building owner does not have that house property in his name. Doesn't matter. This 2 lakh will be taxable under the head house property because it is on account of your past house property. Yes or no? In the year of receipt of arrear as well as unrealized rent, it is irrespective that whether you own that particular house property or not. It is for the past ownership. You are getting an unrealized rent or arrears of rent this year. And hence, in the year of receipt, it is fully taxable under the head house property. The only one and only deduction that you can claim from that is what? Standard deduction 30%. That's it. I hope it is also clear. So that is the treatment for unrealized rent as well as arrears of rent subsequently received. Now there is final last concept in the head house property, that is treatment of co-owned property. What do you mean by co-owned property? Co-owned property, joint ownership. I'll give you one example. Listen. Say I have a house property. I have a house property. It is owned by me and my brother. It is owned by me and my brother. Are you all with me? It is owned by me and by brother. It is a self-occupied house property. Then you need to compute, you need to take 2 computations. You need to do 2 computations. One in my hand and the other in my brother's hand based on the square feet ownership. If we are joint owners, then straight half. In my hand, NAV is 0. In my brother's hand, NAV is 0. Why? Because self-occupied property, net annual value is always 0. But the point is, I can claim up to 2 lakh rupees or 30,000 rupees as the case may be. And my brother also can claim 30,000 or 2 lakh as the case may be, because we both are different assessees. For the same property, we both can claim up to 4 lakh or up to 60,000. What is this 4 lakh and 60,000? 2 plus 2, 4 in total. I can claim up to 2. My brother can claim up to 2. Simple example I'll give you. Say I've taken a loan. After I've taken a loan for this house property and the interest is 5 lakh. And the interest is 5 lakh. This is total interest. We both have taken a loan, joint loan for this house property, and the total interest on this house property is total 5 lakh. Are you all listening? Now listen, this out of this 5 lakh, 2,50,000 is for me. 2,50,000 will be charged on my brother. Yes or no? Since it is a house property and loan taken on or after 1st April 1999, say the loan is taken for either for purchase or construction, then I can claim up to 2 lakh as a deduction and my brother also can claim up to 2 lakh as a deduction. That's what I said. The ceiling limit of 2 lakh or 30,000 can claim separately, can be enjoyed by my brother as well as me. Are you all with me? It is not property wise, it is assessee wise. It is not property wise, it is assessee wise. If for the same property, multiple owners are there, each owner can claim up to 2 or 30, depends upon the case. Are you all with me? Each owner can claim up to 2 or 30,000, depends upon the case. That's what the department says.
To purchase recorded lectures and textbooks, visit our website www.cajosekurian.com.